You're seeking information into the trajectory of the U.S. economy, you're in the right place. I assume you possess a better grasp of the situation compared to the average individual. My aim is to furnish you with the most up-to-date information, enabling you to remain well-informed and ahead of the curve. Presently, the Federal Reserve is increasing interest rates to counteract inflation. Let's delve into the speed at which the Federal Reserve is implementing these rate hikes. Here we observe a 5-year chart of the Fed funds interest rates. It becomes evident that it has surged from 0.25% to 5.5% within a relatively short span. However, it's important to note that similar actions have been taken before. Just a glance at a 25-year chart and a 50-year chart shows this is not uncharted territory. While history can provide some guidance, it's essential to acknowledge that no situation is identical. I understand this distinction. The current scenario involves the Federal Reserve's endeavor to elevate interest rates to rein inflation and align it with the targeted 2% mark. It's pertinent to recognize the multiple gauges of inflation: CPI inflation, PC inflation, headline inflation, core inflation, and regardless of the specific metric, inflation continues to surpass the 2% threshold. Of particular significance to the Federal Reserve are indicators pointing to around 4% inflation, a level at which inflation appears to have become persistent, implying that its decline isn't as swift as desired. Currently, I want to emphasize that there exists a notable divergence of opinions within the Federal Reserve. Unanimity is not their current state. A subset of the Fed members holds the belief that the prevailing interest rates are sufficiently elevated to achieve the goal of reducing inflation to the designated 2%. However, differing viewpoints also abound among other Fed members. Chicago Fed President Goolsbee articulated an alternative perspective, stating rather than arguing about the peak rates, we should probably start thinking about how long does this last. In essence, Goolsbee suggests contemplating the duration of the current situation, implying that it might be prudent to weigh the possibility that interest rates might not necessarily need to be raised further. Instead, Goolsbee proposes shifting the focus towards deciding the timing for initiating interest rate cuts. Goolsbee's standpoint centers on the idea that the federal funds rate at its current level of 5.5% could effectively impede economic growth, given that elevated interest rates tend to curtail economic activity. He essentially asserts that maintaining the federal funds rate at 5.5% could serve the purpose of reining in inflation, without necessitating additional rate hikes. However, this raises a pertinent inquiry. When will the Federal Reserve embark on the process of reducing interest rates, commonly referred to as the Fed pivot? This question holds substantial importance as the initiation of interest rate cuts by the Federal Reserve is poised to invigorate the economy, catalyzing its growth trajectory. I'd like you to examine this closely. It's inevitable that at some point the Federal Reserve will halt their current trajectory of raising interest rates. This is a natural and anticipated occurrence, but historical data might provide some insights. Consider the interval between the last interest rate hike and the commencement of interest rate cuts, which is referred to as the pause period. Over the past 18 economic cycles, this pause has typically averaged around 3 months. However, in more recent cycles, this pause has tended to extend, possibly due to the fact that previous cycles saw higher interest rate increments, making a prolonged pause less necessary. With this historical context in mind, let me outline 3 expectations I have. Firstly, the Federal Reserve is unlikely to initiate interest rate cuts in the current year of 2023. The current interest rate level of 5.5% might stay as the minimum for the foreseeable future, even if there are no further hikes. Secondly, I anticipate that the Federal Reserve will indeed execute interest rate cuts in 2024. This prediction stems from the assumption that if the peak interest rate settles around 5.5% to 6%, it aligns with the historical pattern, indicating a timely interest rate cut in 2024. Lastly, it's crucial to recognize that an economy under the strain of higher interest rates is likely to experience adverse effects. What often goes unnoticed is the cyclicality of business and economic processes marked by periods of prosperity and downturns. The endeavor to mitigate inflation may come at the expense of overall economic well-being, adhering to the age-old pattern of economic cycles. However, it's also important to consider that, like clockwork, The interest rate cuts predicted for 2024 could act as a lifeline for a declining economy, reinvigorating it. This illustrates the cyclic nature of economic highs and lows, which recur predictably. These are my projections, and I want to be clear that I'm not disregarding the current challenging circumstances. However, what I am emphasizing is that operating within a higher interest rate environment will likely exacerbate these difficulties, leading to further degradation of the economy. With that being said, it's imperative to understand that the Federal Reserve's course of action remains uncertain. We cannot definitively determine whether they have concluded their interest rate hikes, or if they will persist in raising rates. Currently, the Fed funds rate stands at 5.5%, but there is potential for further hikes, possibly to 5.75% or even 6%. In a scenario akin to the inflation surge experienced in the 1970s, they might even opt to push interest rates beyond 6%. To offer a comprehensive perspective, it's vital to present both sides of the equation and elucidate the rationale behind these potential decisions. There are indeed valid reasons for considering heightened interest rates. If the Federal Reserve were to halt their current rate hikes, it might inadvertently lead to sustained higher inflation. This could occur as individuals and businesses come to expect and accept higher inflation as the norm. This historical precedent was evident during the 1970s, a period the Federal Reserve wishes to avoid recreating at all costs. It's important to highlight that recent inflation indicators, such as the CPI and PPI, have demonstrated an upward trend. This underlines the need for the Federal Reserve to tread cautiously, preventing a situation from spiraling out of control as seen in the past. Opting for a more cautious approach now could prove to be a prudent measure, averting potentially costly repercussions. Certainly, the inflation rate, without a doubt, has been on a downward trajectory. However, in line with the Federal Reserve's stance, they are inclined to observe consistent evidence that inflation is genuinely moving towards their targeted goal of 2% before making a determination about discontinuing interest rate hikes. Nonetheless, there exists a counterargument suggesting that further escalations in interest rates might be unwarranted and that the current level might be adequately high. To delve into the Federal Reserve's dual mandate, their fundamental mission is essentially twofold. Firstly, to prevent inflation from spiraling out of control, and secondly, to foster maximum employment. This nuanced situation means that while the Federal Reserve is elevating interest rates to curb inflation, concurrently, the elevated rates are exerting a dampening effect on the economy, leading to an increase in unemployment. Presently, the Federal Reserve anticipates a surge in unemployment. This is a widely shared sentiment, echoed by most economists and institutions. Consequently, critics are advocating for a more lenient monetary policy, asserting that the Federal Reserve should proactively counteract the expected rise in unemployment. Now, I need to underline a significant variable that could influence the outcome of this scenario. The Federal Reserve is asserting that they can align inflation with their 2% objective by the year 2025. However, accomplishing this feat would entail substantial economic strain. This prompts an inquiry into the rationale behind the 2% inflation target. Why not aim for 3%? Some skeptics assert that aiming for a 2% target might be excessively stringent. It's essential to comprehend this perspective, because if the Federal Reserve perceives that attaining the targeted economic outcome would trigger unwarranted adversity, they may pivot their strategy and consider a higher inflation threshold such as 3%. While this possibility is on the horizon, as of now, Jerome Powell, the Federal Reserve Chair, maintains that a 3% inflation target is not currently under contemplation. This intricate scenario is marked by numerous variables in motion. A crucial event to monitor is the Jackson Hole Symposium, scheduled from August 24th to August 26th. This annual, exclusive gathering brings together central bankers, political figures, world leaders, and influential stakeholders. This event is poised to yield substantial insight into their strategies and future plans, especially given the diverse voices present and the extensive media coverage. I'll be sure to keep you updated on the developments arising from the Jackson Hole Symposium. Overall, the impacts of interest rate hikes on the economy can be complex and multifaceted. The Federal Reserve carefully considers economic indicators, inflation expectations, and employment data before making interest rate decisions. The central bank aims to strike a balance between controlling inflationary pressures and promoting sustainable economic growth. It's important to note that the transmission of monetary policy takes time, and the full impact of interest rate changes may not be immediate. Economic data, financial market conditions, and global factors also influence the overall effects of interest rate hikes on the economy. In recent years, the Federal Reserve has navigated a challenging economic landscape, with the pandemic introducing unprecedented uncertainties. The pandemic-induced recession led to significant policy responses from central banks worldwide, including massive stimulus measures and near-zero interest rates. As the economy recovers from the pandemic-induced downturn, the Federal Reserve faces the delicate task of gradually unwinding its accommodative policies and returning interest rates to more normal levels. The potential impacts of these moves on various sectors of the economy are being closely monitored by policymakers, investors, and the general public. Please subscribe. Thanks for watching. Until next time.